Good evening, everyone. Can we hear? If you can, I can see that people are saying I can't hear anything. I'd like you to let me know if you can hear me, so that we can kick off. Can you hear me, anyone, please? I think, Deborah, you need to check. We can't hear anything from what you're playing. Faith, can you hear me now? I just need to be sure that you can hear me before we move on. Okay, thank you. I wonder why we can't hear Debbie.
I'm surprised that the audio is not audible. It's playing from my end.
Okay. We can just kick on. We're just going to wait like additional 2 to 3 minutes. Let's have more people join. Okay, so we will just wait a while and then we'll kick off. Just wait 3 minutes. Now, could you, okay, fantastic, thank you. You can hear what Mr. Omoshota is saying, that you need to share sound. You're only sharing the video, obviously, so please, you may need to check that out.
Okay.
Could you please just kindly share the sound so we can hear? All right. We didn't hear it. You still can't hear the sound, so you need to share the sound. All right. Okay. Okay, we're going to be starting exactly 8:10. I think we waited long enough. We have 19 to 20 people in the house at the moment. Okay, the number is popping up. We're just going to launch in immediately, exactly 8:10 on the dot. We'll be kicking off this at 8:10 on the dot. Kindly bear with us. We're waiting for a little bit more people to just join, and then we can kick off. 8:10 on the dot.
Good evening, everyone. Can you hear me? If you can hear me, please just type, I can hear you. Let me be sure that everyone is hearing me. We are about to kick off. Okay. Thank you. I want to welcome everyone to this webinar. Thank you for showing up. It's not easy to leave what you're supposed to do this evening to show up. We appreciate your presence here. And we want to promise you that your time is not going to be a waste, that you will definitely gain something tonight. Tonight is going to be like an experience because the information that we're going to share with you is going to be okay. The information we're going to, let me be on video so that you can see my face. All right. So we're about to start. We're about to share the information that we promised to share with you. And for us to start, the person that is going to lead us to this webinar to expose this information to us is actually, first of all, this webinar is coming from the table of CASAFINA Development. CASAFINA Development is one of the real estate companies in Lagos, and we've been around for so many years. And by God's grace, we've been able to do something great in our few years of presence in Lagos. And because our MD, our group managing director, knows a lot about real estate, even though he is a doctor, but he's a real estate entrepreneur. And with his a lot of experience, he's going to teach you and tell you, expose you to the information that possibly you might know, but you ignored it, or you might know, most of you might not know it. So the person that will take us through this webinar is no other person than the MD, the Group Managing Director of CASAFINA Development, by name Dr. Sheyi. He will be the one to take us through this webinar. And I want to hand over to him to do justice to the topic. I want to employ you, you can take up your biro, take up everything, and just listen and gain something tonight. Thank you.
Thank you very much, Deborah, and thank you everyone in the house. I'd like to, first of all, be sure that we can hear me. That is very important. So please, if you can hear me, I'd like you to just drop a note for me. If you're there, just drop a note for me. Just say I can hear you, or just drop a thumbs up for me if you can hear me. I just like to know so that I'm very sure that we're on the same page. Thank you everyone who's done that. Yeah, thank you for the thumbs up. Now the second question, the second thing I'd like you to do for me is I'd like you to get your piece of paper. I'd like to get a pen, because I will need you to write this down. Some of the things we're going to be sharing will be things that you would take away from this webinar and then to implement in building your real estate investment portfolio. Before we start the journey, I'd like to ask if you've been to any of our webinars, could you, apart from my colleagues, if you are in this room, and you've been to any of if this is the first time you are attending our webinar, I'd like you to just say my first time. I'd like you to just indicate in the chat box that this is my first time. This is my first time. Okay, thank you. Okay, thank you. Oh, thank you. We have quite a number of first timer. You need to let us know, like some churches do. You never can be too sure. We might have gifts for the first time. Thank you so much. Thank you so much. Okay, so I have quite a number of first timer, from Pastor Ajibola to Gilbert Awed to Moshota Day to Yvonne Kerry to Kingsley, Mr. Kingsley Mowite, then Godwin Osara. Thank you, Oris Shoyige. Thank you, Napoleon. Thank you, Larry Kalaje. Thank you, Gilbert Awed. Thank you. Thank you, everyone. Thank you, everyone, for joining. I'm going to be sharing my screen, but just like I said, you need to have your paper with you and a pen, because I'd like you to note some of those things down. It will also help when we're asking a question. Aisha Suleiman, thank you. That is one of the participants here who is Samsung SM835F or so. I don't have your name. I wanted to just welcome you to the webinar. Today, we're going to be talking about real estate investment opportunities. I can guarantee that for a lot of us in this room, we've heard, several videos or several, webinars like this that talk about real estate investment. So the question is, why do we need another webinar on real estate investment? Every teacher everybody's a teacher when it comes to real estate, but then we have different dimensions. For us, we have an holistic view of real estate. We believe that real estate goes beyond just land and houses and hotels and all those ones. It is a financial product in itself. So if you're going to invest as an individual or as a corporate entity, you absolutely need to understand exactly what you're investing in. Not just to understand exactly what you're investing in, you need to understand that how real estate will fit into overall strategy. Let me say this, that if you're building an investment portfolio, do not assume that that the only thing you need to have is to put just jump into real estate. Sometimes you need to have other asset that is related to, that is not necessarily ad asset like real estate. So those are some of we're going to be looking at real estate investment from a very comprehensive dimension. So I'm just going to be sharing my screen. So you need to give me some few minutes. Let me quickly share my screen. And then when you see my screen, I'd like you to just let me know. I want to be sure that, just hold on, please. I'm going to be sharing my screen because I'm going to be share screen. And then just 1 minute, and then we'll be good. Good. Now, I need a favor from everyone. Can you see my screen? If you can see it, I'd like to know. Before I move on, I need to be sure that we can all see my screen. All right. Thank you. Yes, I can. You want Carrie? Thank you. Thank you very much for that. Oops. Okay. Now I was trying to share the link with my colleague. So now I need to be sure, because we can see the PowerPoint slide, right? Real estate investment made simple. If you can see it, before we just kick off, I don't want anybody to miss. We're going to try as much as possible to make sure that we don't take too much of our time. So fantastic. So let's just move on. Thank you, everyone who's giving me very, very short feedback. So now, real estate investment made simple essentially teaches real estate from the viewpoint of investment, not just buying land or holding it. It talks about what exactly do you need, setting financial goal, and adding real estate as one of the steps or one of the instrument or one of the assets in a basket. So a portfolio essentially is like a traveling bag or a box inside that box, you're going to have you can put your shoes inside that box. You could put your clothes, you could put your perfume, you could put your hairbrush. You're traveling journey. Now, if you only put your shoes, you might get to your destination and not have clothes to wear. If you put only perfume, you might get to your destination and not have brush to something to brush your teeth. So that is essentially what a portfolio is, because we're going to be mentioning that word portfolio in the course of the conversation. And the voice is low. Is it still low? Somebody is just telling me now that my voice is low. Please kindly let me know if you can hear me clearly. Is it better now? I'm trying to raise my voice, so if it's better, I'd like you to just let me know so that we won't have too much of hassle listening to me. Is it still low? Is my voice still low, please? Mr. Lasukomi, can you hear me now? Because I'm about to kick off, I need to know. Yes, Pastor say yes. So I'm saying yes that my voice is still low, or that you can hear me very clear. Thank you, Bridget. Show me. Thank you so much. I'm just, I need to be, your voice is good. Thank you. All right, so let's just quickly. So when we, okay, just 1 minute. Okay, thank you so much. Thank you. Yeah, sorry you had to go through that hassle to listen to me. So let's just quickly kick on. Remember that today we're going to be talking about different opportunities. Part of what we're going to be talking about at the end of this session, we're just going to introduce a Vedura resort opportunity to us, but that is not the entire focus for today. Today is to talk about investment vis-a-vis real estate, what you can do, how you can do it, and the best strategy when it comes to real estate investment. If at any point in time you can't hear me, I need to just quickly just point it out to me so that I can stop and then we can fix whatever the issue might be. So let's move on. Let's start from the first thing I want to ask us is this. When you're deciding to invest in real estate, there are some certain key considerations that you need to understand. Number one, what stage are you in your investment journey? Now, if you're just starting your investment journey and you're just beginning to, let's say that you just started working and then you started making money, and then you have about 10, 20, 50, 30 years working life, you know that you have another 30 years. Now, that particular time in your life, your investment need, your portfolio need is different from somebody who is 50 or 60, who is looking at retirement in 5 to 10 years. And those are the dimensions we need to consider. In the course of this conversation, we're going to be looking at what, if you're younger, what should you be looking at? If you're middle-aged, what should you be looking at? Because what your need is at different point in time would differ. For example, the example I mentioned, I said if you're just getting into the workforce, you have 30 years, you're probably not married, or you're just getting married. At that time, you still have a long time to invest. So you can afford to say, look, I want to just put my cash in instruments that would appreciate over time, that can multiply my money. I don't necessarily need immediate cash flow because I'm still working. I can earn. My spouse is still working. I can earn. And then apart from that, even if I make a mistake, I can afford to actually rebuild my portfolio again. Compared to somebody who is about 60, is looking at retirement. If that person retires at that time, I can guarantee that person is not going to, it does not have the length of time 25 or 30-year-old person has. The person is looking at retirement. So what the person is trying to do is to put his or her cash in instruments that are safe, that can guarantee that he or she is going to get cash flow consistently, so that they don't need to depend on children or grandchildren to sustain them. And that is the problem a lot of people have. You find people who are near retirement who are cajoled to buy land. Yeah, there's nothing wrong in buying land if they've made provision for cash flow, for sustenance, and then they say, look, I have excess that I want to put away, maybe for my grandchildren, maybe for my son, maybe for my daughter. Those are those are okay. But if that is the cost source of revenue for them, it might be a very bad idea. So that is why we say that your real estate investment concentration depends on your stage, the stage you are in your investment journey. Then two, what is your risk profile? Not everybody can invest in all kinds of instruments. Now, unfortunately, we won't be able to delve into risk profiling. Every investor, if you're in this room, you need to understand what your risk profile is. We have a free tool that we generally provide that you can just take, and then it will bring out a report that shows you what your risk profile is. You need to understand what your risk profile. Not everybody can take, so there are some real estate investment that are speculative, highly risky, and can fail anytime. Now, for example, now not everybody should invest in the stock market. If you find out that every time the value of the stock market, the All-Share Index is going down, your heart rate is also going down. Anytime it's going up, your heart rate is going up. And then you have to liquidate all the investment at any time. You are confused, you're usually agitated, and so on and so forth. That kind of instrument might not be the best for you. So your risk profile is also a key consideration, and you need to know. There are a lot of free tools, but if you want us to provide it for you, kindly indicate. We will provide access for you to complete a risk assessment that would also provide a bit of gap on what kind of investment you understand that you should take. Number three, you say, what has the third key consideration is you need to ask yourself, what do I want my portfolio to look like? And the thing is, a lot of people leave building an investment portfolio to luck, to chance, to opportunities. It should not be. Building a portfolio is like building a house. There's the foundation, there's a wall, and there's the roof. You need to ask yourself, what is in the foundation? What should be in the foundation? What should be in the roof? And then what should be in the wall of the portfolio and building? We're still going to take, get to that point when we're going to be analyzing what a portfolio should be and what it should look like. How do you build? What instrument do you put there? So you need to decide, do I want more of asset that I bit risky that can grow because I'm still young enough and I can afford to make mistakes? Or do I just want highly secured instruments in my portfolio that can continue to generate cash flow that is sustainable for me because I'm 55 or 56 and I don't want to take any risk? And then the last thing is the concept of allocation. Every investor, if you're in this room, let me even ask you, how many of us, if you're in the room and you're familiar with the word asset allocation, I'd like you to just say hi. If you're familiar with the word asset allocation, I'd like to say, I want to know how many of us are familiar with asset, the concept of asset allocation. You've heard that word, you're familiar with it, you understand what it means. I'd like you to just say, I am. I like to hear, let's get a comment if you're in the house, you understand what asset allocation is, yeah, hi, okay, fantastic. Only one person so far, okay, good. Now, only two people in the house. Now, very few people talk about the concept of asset allocation, but it's one of the most important knowledge you should have as an investor, because you need to ask yourself, if you have so amount of cash, asset allocation provides you the strategy to deploy the investment you have. That is why if you have like a fund, professionally managed fund, one of the things they have at the beginning is the asset allocation strategy. Where would they put this cash? If they have 100,000 naira, where would they put 10,000? Where would they put 20,000? Where would they put 50,000? And so on and so forth. Those are the considerations. You need to understand the concept of asset allocation. It is very important. So those are some of those things we're going to be referring to in the course of the conversation. So let's kick off aggressively into the matter. Now, if you're looking at real estate investment, the first thing you need to ask yourself is, what will my portfolio look like? What will my portfolio look like? Remember, I said real estate is just one of the instruments that can be in your portfolio. Oh, somebody, network frustrating me here, disconnecting, several and connecting again. Sorry about that. So the first thing is to ask yourself, what do I want my portfolio to look like? That's the first thing. You want to ask yourself, what percentage of my investment do I want to be real estate? What percentage of my investment do I want to be fixed deposit, and so on and so forth? Because you need to ask what percentage. Now, before I move on, I like to take a poll, because I just asked a question that what percentage of my portfolio do I want to be real estate? I need you guys to please connect with me on this. How many of us, if you're in the room, you have thought about it, that what percentage of my of the asset I have will be in real estate, what percentage will be in cash, what percentage will be in equities or stock market, what percentage will be fixed income instrument? If you're in the house and you've actually had that conversation, I need you to just drop a note. I want to be sure before I'm I need you to please engage with me on this. You've thought about it. If you have not thought about it, just say, I have not. I've not decided, I've not thought about it. It's not even occurred to me that I need to decide what percentage of my asset will be in real estate, what percentage of my asset will be in cash. If you're any asset, you've done that before, you've thought about that, I need you to just quickly let me know. I'm trying to actually gauge the people in the house so that I can, it helps me to tailor what I say and what I'm saying to everyone. Okay, thank you. Okay, I'm just trying to be sure because it's going to help me to tailor. Fantastic. I haven't 50% real estate. Okay, it didn't occur to me. I haven't. Is there a standard allocation recommendation? Yet to decide. I've not even thought about it. 10%. I've never thought about it. Not thought about it. Oh, great. Now, we need everyone in this room. You need to absolutely ask yourself, what percentage of my cash will be in real estate? What percentage do I want to put in stock? Now, you know why? Because it helps you to decide how to, for every cash you have to invest, it helps you to decide where you want to put it. Now, when if particularly you built a very solid portfolio that is stable, that is based on knowledge, that is based on your understanding of your need, understanding of your risk profile, and understanding of the market. Now, what happens to you is you have built a solid portfolio. So now, one part of your portfolio at the end of my experience challenge, but your house will stand. That is why it's important that you understand exactly the concept of asset allocation. You need to understand that because life is, is tempestuous. Problems will always come. When it will come is the issue. That problem will not come. That problem will come is guaranteed. But what is speculative is when it's going to come. It might come now, it might come in 2 years, it might come in 3 years, it might come in 10, it might not even come in your lifetime. But you need to design and decide to build your portfolio in such a way that when trouble comes, like it will always come, you are in position to withstand it. It's like saying that the storm will not come. The storm will always come, but the sail of your ship will determine, or the sturdiness of your boat will determine how you're going to survive. So you need to first of all ask yourself, what exactly does it mean to build a portfolio? A lot of investors never understand that concept. People there are people probably you may be here in this in the room that you just you just decided, you started working, you just started buying land here and there, and so on and so forth. Without consideration for what is the balance. There are some people that all you have is the cash in your account. By the way, this is not a very good investment strategy because cash is losing value. Every time, every year, you keep strictly cash in your account, you are losing close to 20 or 30% in terms of purchasing power. So, and then the essence of portfolio allocation or portfolio concept is also that that some of your instruments will not be able to keep up with inflation. Some will actually stay ahead of inflation. So at the end of the day, when you do an average, you are still doing pretty well or really very well. And that is the way it works. So let's start. So the question we would ask is this. Please kindly, if you have questions as I go along, I need you to just pop it so that I can add it as in the course of the conversation. So now that you understand that, you absolutely need to get your portfolio right. You need to start thinking that how do I apportion the resource that I have? Where do I put it? Do I want to put it in real estate alone, or do I want to put it in this kind of in this other asset? But let me quickly say this: you can decide to also build your real estate portfolio and design it to fit your specific need. For example, there are 2 or 3 things that is the outcome of every investment. Number one, you want to have capital gain or appreciation in the value of your investment. Number 2, you want to get cash return. Number 3, you want both of it. Now, your goal, if you want, for example, just capital gain or appreciation on your investment, if you decide because I have 20 years to go and I'm still working actively, I'm still earning pretty well. So what I want now is to put my investment in assets that can multiply over the next 2 to 5 to 10 to 20 years. You can just, and I necessarily will not need to actually take out cash from there because I can sustain myself. So what it tells you is that automatically that most of your portfolio, you can say 80% of your real estate portfolio, I'm not talking about portfolio at large, I'm talking about your real estate portfolio will be in hard asset. You're going to be investing a lot in land, bare land,
And then knowing that, particularly when you know how to choose, you know how to choose it. And then you know that you can afford to wait 10 years for that investment to multiply times 20. But if you look at it, you say, look, I'm in my 40s. I want a bit of appreciation over the next 5 to 10 years. But at the same time, I still want a bit of cash flow that I can, so that I can continue to sustain myself. I need to pay my children's school fees and so on and so forth. So what it tells me is that the asset I need to invest in is both land for speculative reasons, and then I need to invest in rental, in rent yielding assets. So I want to buy a short-let apartment, maybe a 1-bedroom or 2-bedroom, and then put it out on short-let or put it out on long lease, so that I can continue to earn money from that particular one. Or if I'm going to buy land, I'm looking to buy land in an area where I can lease it to mechanic, I can lease it for shopping, I can lease it for event center. You know, it might take a bit more cash, but you understand exactly where you are in terms of building your portfolio. I hope I'm not, please, the house seems very silent. If you can hear me and if you're getting value, I'd just like to know before I move on, I would appreciate if you just drop those notes, just drop it. It would encourage me so that I'm sure that I'm not speaking to myself. If you're getting value, just let me know I am getting value. Just, you know, give me a thumbs up. It helps me, it helps my psychology, it helps me to understand that people are listening to me, and it helps me to understand that you know, that you're following. If you, thank you very much, and I hope you're getting value. So you know, a very key component of what we do is to decide how you want to do. So you don't just jump into the market, say, I want to start buying real estate. You need to put it together. If you want to start buying it, what is the goal of the real estate? So let's just quickly move on because of our time. So what is the first step? You know, you look at it, most people will say the first step in investing is to start buying property. That is not necessarily the first step. So I'm just going to skip a slide. You know, by the way, I want to quickly, you know, let you know this. No matter the portfolio you have right now, your portfolio structure can change. So, for example, the young man that you know, the young man that invested all in land, bare land, over the last 10 years, because he knows that he's still working, he's still aggressively earning, and he doesn't need the cash flow. The property that he bought at 2 million is now 30 million, is now 40 million. And then let's say 15 years later, the guy, same person, is now 49 or 50, and he's looking like, look, I want to retire at 55, I want to retire at 60, and he has built you know, a land banking size that is close to 500 million. I can say, look, now I do not need to just have capital appreciation alone. I want a bit of cash flow. So what is he going to do? He's going to rebalance or restructure his portfolio. So that takes me to the next slide. That, you know, whatever portfolio you have at this point, your portfolio can change based on age, excuse me, please, based on your risk tolerance, based on the time you have, or you perceive time that you have, and how much cash you have at your disposal. So the same guy who's built a large portfolio of about 500 million or 1 billion worth of land, bare land across 4 or 5 locations, can decide, I want to take a quarter, let's say it's $1 billion. I want to take a quarter, that's 250 million, sell it off and take this cash and use it to buy 5 apartments in Ikate, 5 apartment in the 5 1-bedroom apartment or 5 2-bedroom apartment at 60 million. I want to buy 5 of it in Ikate and then lease it out, either a short lease or a long lease. And then I know that I can generate additional 24 million every year, but they will pay. So I know that now that I'm nearing retirement, I can see that, you know, every year or every month, I'm going to be getting 2 million from rental properties. And then maybe when I get to 55, I will sell another third of my portfolio and put it back in short-let so that I can actually double my income to keep up with inflation. You can see how this same guy who initially, when he started, was strictly saying, I want to buy assets that can appreciate, now he's considering cash flow as a significant component of his strategy. You can see how that changes your portfolio size. So let's go on. How do you start building a portfolio? What is the first thing you need to do? I want to throw a quiz to the house. When you want to build, what is the first thing? If you're in the house, apart from my colleagues, if you're in the room today, what do you think is the first thing to do? If you're there, please, I'd like to know. I'm going to read out your name and I'm going to say, you know, read out your comment. What do you think? You want to build a portfolio, you've sat down and say, what do I want to start now? What is the first step? Please kindly just participate. Please humor me and just participate. What do you think is the first step when you want to build it? You've decided, I want to actually take a look. I don't want to invest haphazardly. I want to actually be able to pick real estate. I want to be able to pick, I want to be able to organize my investment to generate cash flow, to generate capital appreciation, to actually balance out, to edge against inflation. What is the first step? If you're in the house, there's no right or wrong answer, so please don't be worried. Yeah, so the first person says, what is the first step? I will start investing in land banking for now. Okay, that is Mr. Lainka. If you're, I like more comment. What do you think is the first step? You know, I'm talking a general note now. What do you think? Yes, it's good to start investing in land banking, but there's a process to the entire thing if you want to optimize your investment. If you just don't want to, you know, because, you know, a lot of us sometimes we buy, the way we structure our portfolio, we're losing value. Buy a house, okay. Buy a house, okay. What is the first step? You know, if you want to, okay, let's just move on. Okay, I want to read, set a goal and plan out to achieve them. Fantastic. So let's just move on. The first step when you want to build a portfolio is actually to set a goal, to say, look, this is what, know what the options are. Mentorship, okay. Know what the options are. Mentorship, okay. You know, that are quite a number. Just hold on. I just want to, yeah, it's good to, just 1 minute, ladies and gentlemen. It's good to actually to do that, but you need to understand that beyond just, okay, let me just read another comment. Do research, yes. Now, the first thing is actually to set a goal, to ask what exactly is my goal. Now, let me, you know, which is why I like this question. That if you don't know where you're going, how do you know when you get there? Goal setting helps us to determine what the destination is. Now, you could, you know, for some of the comment, you said, look, I want a house, I want to buy a house, I want to start doing land banking. The question is, what is the goal of land banking? You know, if you want to start land banking, what exactly is your goal? What do you want to achieve? Do you just want to build asset base that, you know, so you can say your net worth is so? Or do you want cash flow? So that's why this question is very pertinent. If you don't, you need to know where you are going. You need to know where you are headed. So because if you don't know where you are headed, how do you know when you get there? You know, I like this particular quote. I was reading somewhere, said, I came to a junction in life and I asked a wise old man, which direction should I take? And he asked me, where are you headed? And I replied, I do not know. Then he said to me, it doesn't really matter which direction you take. You know, if you don't know where you're going, if somebody says, I'm going, and they say, where are you going to say, I don't know. Anywhere you face is the destination. So the first step to building your portfolio is to ask, to set your goal. What do you want to achieve? And this is why we will do a bit of exercise. And I'm going to pause for some few seconds to allow you to actually think through it. I'm going to pause. Now, the question I want to ask you, and I need you to, for those of you who don't mind sharing, you know, with us, I'd like you to share, what exactly is your financial goal? What is your financial goal? I'd like you to write it down, you know, but before you write it down, maybe I'll go forward a bit. You need to actually ask yourself, you know, what is your financial goal? I need you to, if you've written it down, just say, I have. If you know it before now, you know, just say, I know. If you're writing it down, say, I am writing it down. If you know, just let me know, what is your financial goal? You knew before. Please let me get your comment. You know, if you know before, just say, look, I know, I've always had, I've known it before. If you're just writing it down, say, I'm writing it down. If you're thinking about it, I'm thinking about it. Written. Now, you know, written down. Good. Please just keep the response, because the next thing will be actually based on what you have. Even if you know what, I'm still thinking about it. Fantastic. Thank you for that brutal honesty. I know it before. Thank you. Just bring it out there. I know it before. Now, whether you're just thinking about it or you know it before, like some people would have noted here, what is important is this. So let's see what your goal should be. Let me just pause there. I'm still thinking. I know it before. I'm still thinking about it. Okay, so now the second question you should ask is, how did you arrive at that particular goal? How did you arrive at that particular goal? Did you just sit down and say, look, this is my financial goal? Or you calculated what your need would be over time? Or somebody told you you need to set this down? How did you arrive at that goal? That is a question you have to answer. I'm not going to ask us compulsorily to you know, to to say it, but I'm going to ask you, how did you arrive at it? Now, why I ask you to come up with a piece of, with a pen and paper earlier is because those are things you need to sit down and ask yourself. How did you arrive at that goal? I need you to write it down. That's the other question. Now, in setting your goal, is it specific? Is it specific, straight to the point? Can we measure it? And is it achievable? Is it realistic? Is it time bound? I'm sure all of us are familiar with the SMART concept, but what I want to really call your attention is, for those of us in this room, in this class, who have said, I know it before, I've written it down, or I'm writing it down, I need to ask you a question. How many of you have put, because when you say I want to be rich is not a financial goal at all. I want to be rich is not a financial goal. So do not set a goal that you want to be rich. Everybody wants to be rich, but not everybody understands what rich is. So I need you to take a look at something. I need you to ask yourself, let me even ask you, how many of us have put figures to our financial goal? If you have, I need you to just drop a line for me. You have put figure. You're saying that I want to be worth 1.5 billion naira by December 2027. Now, I said, that is a very simple, measurable, and time-bound goal. The achievability of my goal is now determined based on my current status. The achievability of my goal is based on, but quickly, let me just encourage us that sometimes when we're setting those goals, we need to understand that, when you have a plan to achieve those goals, sometimes your plan might be more important than where you are. Let me repeat that, because sometimes the mistake a lot of people make when they're setting financial goal is to set financial goal based on the current status or based on the current scenario of your life. Sometimes you set financial goal and then you know that this is what I want to pursue and I can achieve it because I'm building myself, I'm developing myself. So sometimes when you are setting financial goal, it's not because you are earning 500,000. You now believe that strictly your financial goal should be limited to what 500,000 can achieve. But you can decide, say, look, I want to set a financial goal that 2 million can achieve. And then you now ask yourself, what do I need to do from 500,000 to 2 million? And those are some of the things those are some of the ways that when we set this financial goal, it helps to drive us towards the achievement of it. So if you're in the room today, you think that the financial goal that you've set for yourself is still a bit low, you need to ask yourself, what else can I do better? How can I make it better? How can I make it better? So that is what I'll be pushing to us today. Just 1 minute. If you're in the room, if you're in the room, and you are sure that you've written down your goal, it is measurable, it is achievable, or it is time bound. You are saying that, how many of us, I asked us, how many of us have written down, you've written down your goal. Somebody said, I know it before. Somebody said, yes, I've written it down. Somebody said, different things. Now, if you have put a figure to it, you don't need to tell us the figure. I like you to just drop a note. I have a figure to it. And then particularly if it's not time bound, if you're saying, look, I want to actually build a portfolio that is valued at 1.5 billion by 2023, I need you to just not pause me. I'm going to pause because I want you to pause. I need you to interact with me on this. This is the crux. If this is the only thing we discussed today, it is enough that you understand how to set financial goal. You understand to make it figures. You understand to make it time bound, and you have concrete plan to achieve it. Even if you don't have the immediate means to that, sometimes what we achieve is much dependent on our ability to strategize towards achieving our goal, even if we do not have it at the moment. Let me quickly read this. The figures fluctuate. Fantastic. Does it fluctuate down or up? I need you to answer that. Does it fluctuate down or up? Kindly let me know. Does it fluctuate down or up? Okay, the figures fluctuate down. Okay, now, this is what I would advise. When you set your financial goal, the only destination that you must head is upwards. You know why? Because inflation is dealing with, okay, now I'm going to use the example of somebody here. He said, my target is 1.5 billion by 2024. let's put a figure, a time to it, say by December 2024. Now that is a specific and measurable target. Now, and he's saying I have roughly 20 to 24 months to achieve that. That is a goal. Now, the next question to now ask is, for example, I'm a real estate salesperson, and if I decide that my immediate goal is 500 million by 2024 December, I know it's 500 million. My next question will now be, how much do I need to sell? How much real estate do I need to sell that can fetch me that kind of commission? So I will look at it that if I sell a property that is worth 100 million and I get 10%, I said 1 billion, by the way, I said 10%. That means I need to sell 100 over the next 2 years for me to achieve my goal. If my target is 200 million, and I know that I can see properties that I sold at 500, there are duplexes that people are selling at 500 million. I know that my commission is 10%. I know that for every unit of 500 that I sell, I'm going to make 50 million, and my target is 500. So I only need to sell 10. You can see how if I set my goal, I can structure my plan backwards and then from the back, and then shoot towards achieving that kind of portfolio. And I've not even factored in the fact that the cash I'm investing will still continue to yield interest for me. Somebody says, sometimes I think it's unrealistic because I didn't meet the goal at the end of the year. I understand that it could be discouraging sometimes when you set goals and you don't meet it. But you need to sit down and ask yourself, why did I not meet the goal that I set for myself? Part of what we need to keep doing every time is to audit. For example, some of the goals I set last year, I did not achieve them. And I understood this because I'm very poor at execution. So part of my focus today in this year is I need results for myself, for the company I lead, for the people I work with. I don't want any excuse because execution was a major problem earlier. So let's just quickly move on because of our time. So I said you need to actually set your financial goal. You remember we started talking about asset allocation. Asset allocation helps you. Now, let's say that's the first step is to, when you're building your portfolio, is to set your goal. The second step is to understand the concept of asset allocation. Like I said, it's an investment strategy that aims to help you balance between risk and reward, so that by apportioning your assets in different classes. Now, this is the challenge with a lot of entrepreneurs. If you're an entrepreneur, you're in the house, I like to just say hello. Now, a lot of entrepreneurs, when they are building their companies, they put 110% of what they have into the company. While that is good, because a lot of time, particularly if you're in the startup phase, your company is the most important asset that you have. It's taking all your time, it's taking all your energy, it's taking all your blood. But you need to actually start asking yourself, do I need to actually set aside a portion of whatever revenue we generate? If you're an entrepreneur in the house, you're running your own business, I like to just get a bit of, just say hello to me, so that I know, so that I can address that very well, because that is a mistake a lot of entrepreneurs make. We tend to think that, hello, thank you. We tend to think that we only need to put our cash in the business all the time. Sometimes that can be a wrong strategy. As an entrepreneur, you need to actually ask yourself, how do I want to structure my portfolio? Because let me say this, that what would happen is this. Now, whether you like it or not, business is one of the riskiest asset class anybody could have. If you've run business, you understand what I'm saying. Because the business you have, let's take a look at statistics. Now, it said 90% of all startup business will fail in the first year. Of the 10% that is remaining, over the next 5 years, another 90% of that would actually fail. So essentially, only 1% of businesses will survive the 5-year mark. So the question I want to ask, if you're running a business, and all the assets you have is inside that business, then you need to understand that you have invested in some of the riskiest asset class that is available in the market today, because you are betting against 1% chance of success. So how do you need to structure it? As you generate profit, you reinvest the bulk of the profit in your business. But what you now need to do is to say, look, I'm dedicating a portion of my revenue to invest in fixed income instrument, to invest in fixed deposit, to put inside federal government bonds, to put inside treasury bills, to put inside different kind of asset. Because at the end of the day, businesses would have its own ups and downs. Sometimes if you are not careful, you'll be cash trapped. When you're cash trapped, you can go back to the other side of your portfolio and you need to cushion the challenge. I'm not saying you should do that, but let's say you're pushed to the wall. You know that you have a buffer, and that is what a lot of entrepreneurs refuse to do. And it's understandable. They put every dime reinvested in business. You need to diversify. So diversifying your risk base is part of what you're doing. when you do that. Please, I hope we're getting value. I hope I'm not talking above, I'm not just rapping and we're not getting it. I need to be sure so that I can quickly move on. Thank you so much, Bridget, for corroborating that. But please, if you're getting value, I like to just know again, I keep wanting to get this feedback, because when we're taking this virtual session, it's very easy for us to actually assume that people are listening. Meanwhile, you have actually just wasted their time and their energy. If you're getting value, just let me know so that I can actually push on. I need to be sure. Thank you very much, Mr. Kingsley, for that. Thank you. Just, can you just boss it? Let me see a bit more activity. Thank you, Faith. Thank you, Sukome. Thank you, Stella. I really appreciate that. Yeah. So essentially, what we said is absolutely getting value. Thank you. So as a business person, you need to actually sit down and ask, what is, particularly if you're the business owner, your business is just one aspect of your portfolio. So if you're strengthening only one aspect, then you need to be sure that, you're not killing off the other side of it. So that is basically what you need to learn and what you need to do. So let's go. Let's quickly move on. How do you now build? How do you allocate your asset? That is the next thing we're going to, we talked about asset allocation. So how do you allocate your asset? Now, when you're building a portfolio, it's like a house that you're building. Thank you, everyone. It's like a house that you're building. There's this foundation, there's the wall, there's the roof. Now, the foundation is the most secure part. If the foundation is solid, no matter what happens, your house will not come crashing down. And I made this mistake, in the course of my investment life. And then, I built quite a very huge investment portfolio. I invested in high-risk instruments. And then at a point when the economy was challenged, everything came crashing down. I knew guys who took loans of 50, 100 million 10 years ago to invest in the stock market, and they put everything within the stock market. And what happened? When the stock market crashed, their entire investment crashed. I know somebody who invested close to 60 million and came out with just about 4 or 5 million. And then that means the person has lost about 50 something million thereabout. The guy had to resign from work. That is one of the challenges when people don't understand how to build the correct portfolio. There are 3 levels to building correct portfolio. There's the security, which is a foundation, there's the growth, and then there's the multiplication. So what does it all mean? This is the model we have adopted. So let's quickly look at it. What does it all mean? I'm just going to skip to the 3 level, the security bucket, the growth bucket, and the multiplication bucket. So what are you going to, now let's quickly break it down a bit before I go on to what kind of instrument should be at the various level, whether security, growth, or multiplication. Now, essentially, your security bucket is the foundation of your investment portfolio. And then the instrument that should be in this particular bucket are risk-free instrument that that come rain, come shine, you will always get your return, you always get your rental yield. What are those instruments you're talking? So let's quickly take a look at it. What are those instruments? You're looking at money market instrument, fixed income instrument. Rental properties will fall into this category, particularly if you have real estate asset that is located within an area of high rental demand. Treasury bill will fall into this category. Real estate will fall into this category. Bonds will fall into the category. Fixed deposits and commercial papers and mutual funds will fall into this category. So if you're looking at it, if you decide, we're still going to talk about risk, and then I want to understand, how do you divide? Let's say you have 100,000 naira to invest in. How do you divide the 100,000 naira? So in your security bucket, these are the things you would have. Now, when you've built this to an extent, if you're somebody who does not like risk at all, your security bucket should form the bulk of your portfolio. It might be up to 60% of your portfolio. That is what it should be. So if it's 60% of your portfolio, that means if you have 100,000 to invest, the bulk of your 100,000, 60,000 out of the 100,000 should be invested in commercial papers, fixed deposits, in bonds, in real estate, particularly rental income yield on real estate, and so on and so forth. Now, if you're looking at the securities bucket, what are those instruments that should be there? Real estate also falls into this category. This is where you actually invest in stock market. This is where you invest in equity-based, and this is where your real estate portfolio, your business portfolio falls into. So what am I saying? Because I started at the security bucket does not mean that all of us must start at the security bucket. Sometimes you're already investing heavily in the growth aspect of your portfolio. So, and you suddenly realize that you need to balance it. So what do? You take part of the cash, which is where, for example, I was talking to business people earlier, that as you start to generate profit, take part of the revenue you're generating, put it in fixed income instrument, put it in fixed deposit, put it in, federal government bonds, put it in all those instruments. Now, the question you would ask me, what if I need the cash? There are a lot of ways you could actually play creatively around it. For example, if you're invested heavily in fixed deposit or federal government stock bonds, what you can do is you can even take those federal government bonds to the bank or the fixed deposit you have in the bank and tell the bank, borrow me money against this asset. So you can get some liquidity back into your business. At the same time, you still maintain your investment portfolio. I'm sure question will still come up in the course of the conversation related to this. Now, the multiplication bucket is the one that is, that has astronomical return. We're talking about commodity trading. We're talking about private equity. We're talking about Forex. We're talking about some speculative real estate, digital currency for those who care to invest in those assets. This is what you put in the multiplication table. But the problem with a lot of people, even some of us that are in this room, in this class, is that we start from the multiplication, which is the part of your portfolio that comes with the highest risk. Let me show us the risk level again so that you understand exactly what I mean. That is, if you look at this, the multiplication, it comes with the highest of risk, but this is the one that is very attractive to a lot of us. So I find people who don't have an understanding of Forex, who are putting a lot of cash into Forex, putting a lot of cash into commodity, putting a lot of cash into speculative real estate investment. Those are the mistakes that people made. The challenge is this instrument, yes, they can generate a very awesome amount of cash for you, but the same way they generate is the same way they can actually flip over, and then you would have significant or catastrophic problems. And that is the way it works. So you need to also always understand, to always have caution when it comes to these aspects. If you've not built your foundation, if you've not built your wall, you really do not have so much of business building these very speculative instruments. You need to sit down and ask yourself, what is my risk profile? Let's quickly just move on. You need to understand which takes me to the next slide, understanding your risk profile. Now, unfortunately, we won't be able to delve into risk profiling because it will take more of our time, but I wanted to share a link that you could actually just take. It's a 2-3 page test, and then it gives you a report. By the way, it is not diagnostic itself. It just gives you an insight into what your risk temperament is. That should affect where you invest your cash. So we've been talking generally about real estate investment, about investment generally, how you need to set your financial goal, how you need to build your portfolio, and then how you need to deal with all those issues when you are allocating your resources. I understand, I believe rather, and I hope that we've understood that up to this point. So we're gonna, the topic for this webinar is real estate investment opportunity, but I needed to lay the foundation so that we understand exactly when we say we're building our portfolio, what we need to do. Just a minute, what we need to do per time. So now let's move on to options in real estate investment. I'm just going to run through because of our time. We've already spent enough time. Now, when you're investing in real estate, I've tried to simplify what the options are for you. When you can invest in land, you can invest in residential real estate, you can invest in commercial real estate, and then you can invest in real estate backed instruments. What are real estate backed instruments? So for example, a REIT, real estate investment trust, is a financial instrument that is predicated on underlying real estate asset or real estate related loan or mortgage. So that is one. There are bonds that are related, they are real estate backed bonds. Somebody wants to do a project and is doing a private placement, and is saying, we have this 3-year bond to build this particular project. That is what we want to do. Okay, so but what I've done is just simplified it to 4. What are the options that you have? You have option number 1, you can invest in land, you can invest in residential real estate, that you want to buy an apartment that you can rent out, you want to buy a 1-bedroom, 2-bedroom, or 3, you want to buy a short-let apartment, and then you can invest commercial real estate. Commercial real estate is myriad. You can buy shops, you can buy hotels, you can buy, different kind of stuff. Those are the commercial, and then you can buy other assets that are listed. Recently there's one company that launched a form of real estate investment instrument in the capital market. If you're interested in real estate, but you don't want to do brick and mortar, you can decide that is how I want to be exposed to real estate. So these are the options that you have. Now, the question we need to ask ourselves is, which option is good for you? Let's go back to where I started when I said you need to understand what your financial goal is. You need to understand what your risk profile is. And I've talked about that before. And then once you understand that, it's easy to actually say, look, this is the option that is good for me. But I'm going to tell us some of the opportunities that are available when it comes to, I'm going to break it down to land, and I'm going to break it down to residential and commercial real estate. So, and I'm going to be mentioning the trends, the opportunity we need to look out for. Now, you know, in deciding to buy land, I need you to understand one thing. Just a minute. I'm going to try to, I want to change what we have on the screen, and then I will, just 1 minute. I want to, okay, just 1 minute. I'm trying to see if I can show us. Okay, but it's not coming up. So we just move on. We just move on. All right, good. So let's say you decided that, you know, the options you have is land you want to focus on. Now, the question you need to understand is this: how do you decide what to invest in when it comes to land? And I'm going to start by going back in history lane. I remember that the story of Lekki Phase 1, or the entire Morocco. Now, for some of you, you will not believe that the current day Oniru, you know, that the later part of Zumba and Badiwe, all those where you have Oriental Hotel and Lekki Phase 1 were swampy areas that were slums in the late 80s, early 90s. Now, the story has it that the then military governor was, you know, the president of the country, I think was Babangida at that time, you know, came to visit Lagos. And then I think it was Colonel Raja Rasaki at that time. And then, you know, they went on a road trip because they were commissioning a road. And on their way back, they were attacked by robbers within that area of Ikate, Lasson, Lekki Phase 1. And then, you know, the governor made up his mind that today I am going to, you know, this time I'm going to actually clear the slum in this area. So what they did simply was to demolish. That's the Morocco massacre or Morocco crisis that happened a long time ago. They demolished the entire place and then began sand filling the entire place. That was just about 20 to 30 years ago. That's 1990s, about how many years ago now? That's about 30 years ago. Now, you'll be shocked that at that time, a plot in the dense swampy Lekki Phase 1 was going for between 1 to 3 million naira for a full plot of 600 to 1,000 square meter. Now, fast forward to today. How many of us have an idea of what that land will be? Now, listen to the story, because I'm going somewhere. I will relate it to how you make decision, what you need to look out for if land banking or land investment is your target. So that is the story of Lekki Phase 1. Abuja. Now, when the federal capital was moved to Abuja, Abuja was a collection of villages. Now, what was done was massive investment in infrastructure. And then today, the same cluster of villages that were sold cheaply are sold, some areas in Abuja are sold for as high as 800 to 1 million naira per square meter. That means if you want to buy a plot of 600 square meter, you probably will pay between 400 to 500 million today. Now, because of our time, I'm going to skip the story of Dubai. Now, why is this story relevant to what we're doing? Now, history will always repeat itself. It's just that the players do not understand what they need to do. The players do not get it. The players do not go back in history so that they can understand the present and appreciate the future. It is the person who understands where he or she is coming from that will definitely understand where, you know, appreciate where he or she is, and then can actually push into the future to understand what would happen. Let's take a look at it. I told you the story of Lekki Phase 1. I told you the story of Abuja. I skipped the story of Dubai. Now, what exactly is happening now? Okay. Somebody wants to communicate. Vaughn Kerry wanted to communicate something. They said, oh, yes. Now, so let us look at what is happening today. You know, because remember, I'm saying that if you want to invest in land, if land banking is your target, you know, I've said the three options. You can do land, you can do residential, you can do commercial, or you can do real estate backed instruments. So if land is what is of interest to you, and you understand exactly what your portfolio is, now, how do you identify opportunities? Let's go back to the story I told you. If you were available, if you are around in the early 1990s or late 80s, and you saw what was happening at that time, would you have been able to take advantage of that opportunity? Now we are here again today. What exactly are the things that is happening today? Let's take a look at it. I was reading, sometimes last year, is it last year or 2 years ago? Lagos State government raised a bond of 137 billion. A chunk of this cash will be used to build the road coming from Ekpe to Eleko Junction and then to VGC. That is number one. Number two, Lekki Coastal Road, the road that is supposed to link VI to directly to Eleko Junction, dual carriage running along the Atlantic coastline has been commissioned. There's significant preparatory work towards that particular project. If you check Lekki Coastal Town today, you will see a lot of articles on it about what Lagos State is doing, about what is happening, and so on and so forth related to that. Now, that is number two. Number three, the fourth mainland bridge, I'm sure we're all aware, has been signed off for the consortium that won it. This project is supposed to link Ikorodu, some part of Mowe, to Ibeju-Lekki and Etiosa local government. The leg will reach as far as Ibeju-Lekki, thereabout. This project will cost roughly 2.5 billion. That is the third story I'm going to tell us. The fourth story I will tell us is the deep sea port. The deep sea port is completed today. The first set of ships berthed a while back. Now, at the beginning, the deep sea port was said to be, it's going to be, the cost of construction or development is about 1.5 billion US dollars. And then lastly, the Lekki International Airport has been announced, has been approved by the federal government. Now, this is what I need you to take a look at to understand. I told you the story of Lekki Phase 1. I told you the story of Abuja. I am telling you, that was 30 years ago. I'm telling you the story of Ibeju-Lekki. Now, are we going to see that jump in development? We may not see it. A lot of that area today is emerging. There's rapid capital, appreciation, rapid increase in price of land. But this is not where the cashing out is. In another 10, 20 years, the same story of Lekki that I told you will be repeated in Ibeju-Lekki. So you need to understand that. So, let me not even skip. Let me just skip forward a bit. So you need to ask yourself, so how do you understand, how do you gauge, how do you identify what to invest in? How do you identify two things that you need to? First of all, I said, one, you need to understand where government is spending. Once you start seeing a massive government expenditure in a particular area, that area is ripe for development. That's one way to identify opportunities. If you look at the expenditure, capital expenditure of government and private sector, or a combination of both, the number one destination in Nigeria today is Ibeju-Lekki. That because, and I'm going to teach you how you identify those opportunities. Lekki Coastal Road, the fourth mainland, the deep sea port, international airport, those are some of the government spending that tells you what is going to happen. Two, you need to understand the direction of commerce. How do you mean? Businesses. Once business start flowing in specific direction, you can guarantee that value would appreciate in those areas. So let's take a look at it today. Lekki International Airport, I've even mentioned that before. The Lekki Deep Sea Port is already there. Dangote Refinery, that is projected to go up about $20 billion, is being built also in Ibeju-Lekki today. Lekki Free Trade Zone, at completion, that project would cost about $20,000 US dollars. Today, it is being developed. Factories are already there. I took a look around to see, look, how many factories do we have there? We have in excess of 40 to 50 different companies that have taken their stake and are already producing within the free trade zone. Now, the second thing you use, I said government behavior or spending. That's number one thing you need to look out for. It might not be Lagos, but you can use this same template to actually decide whether an area in Ondo, in Akure, in Kogi, or whatever it is ripe for investment. Number two things is direction of commerce. And I'm using an example of companies that are beginning to set up within that same axis. Using an example of Ibeju-Lekki, you can apply to other areas. The third one is the direction of migration, particularly young, upwardly mobile working class people. What is the direction of migration in that area? Let's take a look at what we have in this place. Number one, the Lekki Deep Sea Port. Now, if you look at the figure there, Lekki Deep Sea Port would directly generate 120,000 jobs and then indirectly by the supporting service, another 800,000 jobs. That is nearly 1 million people within that same axis, because the people that work in these places would love to stay within that area or within short distance from that area. So if you're considering investment and you are looking at the trend of migration, you know that you need to have, say, stake within the Ibejuleki area or in the adjoining area, because that is where there will be demand. Number two, the Dangote refinery generates about 200 to 300,000 jobs directly and another 600,000 jobs indirectly. Lekki Free Trade Zone is projected that it will generate 300,000 jobs and then 600,000 jobs indirectly. If you look at just these three projects that I've mentioned, this is about 3 million jobs that will be generated. That means that 3 million people will be working within that axis over the next 2 to 5 to 10 years. Now, if you don't understand, if you don't understand the implication of having 3 million people work there, the entire Lagos population is estimated to be 20 million. That means about 15% of Lagos will be relocating towards that axis over the next 2 to 5 years. Now, you can imagine, you can use it to project what the demand will be on real estate related land or other asset. So, I mentioned government spending, I mentioned commerce, I mentioned migration. Those are the things you look out for when you are, when you are deciding what you are going to, you can have a recorded version. Yes. So when you're going to, you can see how three things: direction of government spending, direction of commerce, direction of migration, and how this will tally. You can apply this across any thing that you want to do. Now, I've mentioned those three filters you can use, and if you're in the room and you're still thinking about whether you should invest in this or that, whether you should invest in real estate or whether you should not, you need to actually ask yourself, if you are not investing particularly in this axis, then you are missing out. Now, let's assume that it's residential real estate you want to invest in. How do you identify the opportunities? There are some filters you can use. Demography is one thing that will determine what is the age range, what are the information you need? What is government plan in terms of road network, in terms of what they want to build? Let me use an example. I'm going to just skip, I said government behavior is a government plan. Now, for example, if you are looking at, there's something called mainland, the development plan that Lagos State has. I'm going to use Lagos State because that is where we are at the moment. Now, if you take Lagos Central, I was reading through Lagos State development plan, and it said specific area in Yaba, Lagos is building, they've designated about 40 plots to build a mini Silicon Valley, and then 50 acre in Jakonde to build a mini Silicon Valley. Now, what it means is that these two environments will attract high-tech businesses. Mostly young upper mobile professionals will come to work. Those who are coding, those who are all the software developers, product managers, and so on. Those are the people that will come to work within that environment. Now, if they come to work within Jakonde or Yaba, they will need accommodation within that environment. But because they are young upper mobile, you need to understand that the kind of apartment they would need may not be gigantic 5-bedroom or 6-bedroom flat or 6-bedroom duplex. What they will need are more compact apartment, preferably service, if you understand the demography or the demand of Gen Zs and and this kind of age group. So when you are looking at investment in residential accommodation, you want to ask which area would have government plan for the future. You want to buy now and then wait for that to emerge, and it will emerge, and then you can cash in into that. So if you have 1-2 bedroom around Yaba, around Jakonde today, I can guarantee you that will be significant source of cash flow for you. So different kind of government plan is available. Food logistic base in Epe, jetty terminals across Epe town will tell you that this area will be like bus stop or commerce. So buying land within where the jetties will be, go look at Epe development plan. You can buy land around that area because it's going to be heavily commercial. Transport corridors will tell you what to invest in. So you can see how, when you understand government plan, you understand where to put residential real estate. Now, so what are the key considerations? I've told you, how do you filter real estate investment? How do you know where to buy land? How do you know where to buy residential? How do you know what type of residential unit you want to buy? Those are the things I spoke about. Those are the ways to identify those opportunities that you need to log on into. Now, what are the key considerations when you're having real estate investment? There are three things you need to know. And this is very key. A lot of people that invest in real estate today, they just buy it and they say, oh, what is the rent on that place? The rent is 2.5 million. And they okay, let me but what is the rent in that place? The rent in that place is 5 million. They don't understand the concept of return on investment. When you are buying properties, let me say this, that it is not the absolute rent that you get that is important. It's the rent you get over the amount you're spending. Let me use an example. Now, I have somebody I consult for, and the person was interested strictly in cash yielding or rental asset. Now, and he was saying, look, what should I buy? Now, he had 50 million at that time. And he was saying, look, you know, a friend of mine said I should go and buy these assets in Lekki Phase 1. For that time, it was about 65 to 80 million. And he said, fantastic, is a good one. You're buying a duplex in Lekki Phase 1 for 2 or 3 million there, for 60 to 70 million there. But fantastic, there's nothing wrong with that. And I said, how much are you going to rent the duplex? He's going to rent the duplex. That time, he would have rented the duplex out for like 3 million. Now, he bought it for 60. He's renting it for 3 million. Now, if you look at it, fantastic. Maybe because the rental stuff is very high. But if you look at it, what is the concept of rental yield? How much is the rent as a percentage of what you are spending to buy? Then we exploited a second option. We said that same 60 million thereabout, 60 thereabout, will buy a face you apartment in Mushi. And in Mushi, on each floor, there are about 16 rooms or 16 units of self-contained. For us, you know the normal face you self-contained. So 16 times 3, that is total of about 54. Each of those rooms was going to pay 3 to 400,000. Let's even use 300,000. Now remember, there are 54 units. 300,000 times 54 is about 16.2 million. Thereabout. The same amount of money would give him about, let's even round it up to 50 million in Mushin, but would give him 5 million in Lekki Phase 1. Now, if you want to calculate, so let's see. So when you are buying rental property, what should be your consideration? 2 things. When you're buying real estate generally, I'm still going to come back to where I started from in terms of those metrics that you need to know. Capital gain, let me throw this to the house. How many of us know what capital gain is? Let me just, because of our time, I'm just going to explain it. You buy a property at 100 naira, you sell it at 150. Your capital gain is 50 naira. That is about 50% increase in 50% appreciation. That's one. You need to understand what the definition is. Rental yield is, I said gross or net, but let me just define it. Is your rent divided by the cost of purchase of the property. There will be a recorded version of that webinar. Thank you. Your rental yield is your rent. So if you buy a property for 50 million and you're renting out for 5 million, your gross rental yield is 5%, is 10%. That's 5 million naira rental divided by 50 million that you bought the property for. So that is what your rental yield is. These metrics are very important when you are buying. So even sometimes a lot of us make the mistake. Sorry, hold on. It looks that my screen is now. So what I did here is to see, let me show us a calculation of what rental yield is. You can see this man, he bought the property at 600,000. The property is valued at 600,000. His rental income per year is $23,400. And so divide the rental by the value of the property, multiply by 100, that gives you what your gross rental yield is. For the next one, you would have removed your cost and so on and so forth. And then what is your return on investment? Maybe that's when you sell the asset, the gain you make from the rent accumulated over 1 to 3 years, plus the capital appreciation that you have, forms your total return on investment. Now, this is what you should be concerned about. You're not necessarily about how much is the property. Sometimes you can buy a property you can buy a property for 20 million, but you know that but unfortunately the rent in that area is not more than 200,000. If you divide 200,000 by 20 million, that is actually less than 1%. But you can decide, instead of buying that property for 20 million, you can borrow and go buy the property, a bigger property at 40 million. But because of the demand for rental in that area, you are getting 4 million in terms for rental. Your rental return is about 10%. You can see times 10 or what you would have. Even if you net off your cost, it will still be better. So see, please, when you are buying, price is not the challenge. Price of the property you're buying is not necessarily the most important consideration when you're buying residential real estate. It is your return, the return that you can get on that property that is much more important, and that is what you need to focus on all the time. So you need to do your calculations together as it is. So what I've done over the last I think we spent like close to an hour plus thereabout, is to show someone that you don't need, when you're investing in real estate, is not, oops, can we all hear me? It looks like, hello, can we hear me? Because I can't, please, if you can hear me, I need to know. I've spoken for so long that I think I've missed, please, if you can hear me, just kindly, just quickly, just tell me we can hear you. Okay, thank you. Thank you so much. Thank you, everyone. So essentially what I've shown us is one that, how do you need to understand real estate investment from the viewpoint of, portfolio, a more integrated approach, not just, oh, I want to buy land, I want to buy a house, but you understand that it's one of the instruments that you have in your portfolio. I've spoken about how to build your portfolio, what you need to look out for, how you need to understand what your risk profile is. I've talked about how you should structure your investment. I've talked about how to set financial goal. And then I brought it down to, I coned it down to, if you're investing in real estate, what are the options that you have? Residential, commercial, land, as land banking, or a combination of both, or real estate linked investment instruments. And then I've asked us, if land is what you're focused in, what are the filters that you need to use to identify opportunities? And I particularly recommend the Bejuleki, because that is in terms of investment per square meter, the Bejuleki today in the whole of West Africa has the highest investment per square meter that you need to actually, that is actually happening, because the billions of dollars that is flowing into that cannot just be quantified. And that is the one that is above the line. There are a lot of other investment going on that you may not be aware as that today. So, and then I also, Ekpe is part of the axis we're talking about. And then I also now went on to say, look, if rental property is what your consideration is, what are those things you need to know? That was when I mentioned government plan, I mentioned infrastructure, I mentioned the direction of commerce, how, the motion property that I was talking about was able to get that kind of rental yield because it was close to motion market, and there was demand for that particular environment. So you need to understand that. So I've mentioned, how do you identify the opportunities when you're looking at the demography? So the example of the I said Lagos State is building a mini Silicon Valley in Jakonde, and it's building one in Yaba. If you understand, if you go and check the Lagos Central Development Plan, you understand where that property would, that project would be. You can start understanding that the demography of young polymobile people that will come there will require serviced apartment, require 1, 2, 3 bedroom apartment, not necessarily duplex. So you want to position yourself. So those are the ways you identify opportunity within the residential real estate environment. I also will now quickly just say, launch one of the opportunities we have. We're currently selling at pre-launch price an estate that we have in Ibejuleki. If you are interested, we call it Vedura. Vedura is supposed to be a residential resort. Essentially what we're projecting at the moment is to say, look, if you invest in Vedura today, you can guarantee that over the next 1 year, you are going to be having a 50 to 100% capital appreciation. The question people would ask me is, how can you be so sure that you will get that kind of capital appreciation? We've done it before. For those who are familiar with this property, this is Lekki, somewhere opposite Lekki Phase 1. When we sold about 2 years ago, we sold each unit for roughly 50 million. Today, each unit is so easy. For those who bought at that time, this is one of our projects. We're selling this project. For those who are reselling in the market, are selling at about 100 to 110 million today. So those people got, over the course of 2 years, have gotten virtually 100% return on their money. That's an average of 40 to 50% return on a yearly basis. That is what they have. Somebody is asking to give details of Vedura. If you please, any of my colleagues, kindly post detail of Vedura so people can essentially read it. If you're interested in that, we're doing a pre-launch for this one. We're selling a significant discount over what we'll be selling when we launch. We're going to be building them. They're going to be having a mini resort there as we build. So if you're interested, please kindly, my colleague would come up. I don't know if Chris is in the house right now. Hello, Chris. Is Chris in the room, please? So my colleague will just come up briefly. If you're interested in learning more about the Vedura opportunity, we're happy to.
We have a form, sir. I'm going to post it now.
Okay, so you're going to post the form, I guess.
Let me post it.
Yeah, okay. So my colleague will be posting the opportunity, the link where you can put down your details. And then once we get your detail, we'll get back to you. I'd like to thank you so much for taking the time to be here. We started with about 20-something people. At the highest point of it, we had about 42, and we've maintained that peak. We're about 39, 40 right now in the house. I'd like to thank you for taking the time to stay till the end of this webinar. It was supposed to end at 9, and this is roughly 9:30. Thank you so much for your time. Sorry, what did you say? I would like to take your question now before we call it a day. Thank you so much for the time. Thank you. Thank you so much for your time. I would love to welcome your question. I would love to have your question. Please kindly, we've posted the form. If you're interested in the Vedura opportunity, kindly please just fill the form, and then we would get back to you. One of our sales consultants will get back to you, and then would engage with you so that you can take advantage of this opportunity. I'd like to thank you so much for being part of it. We hope to see you in our subsequent webinar. So I'm willing to take your question now. Thank you so much. Thank you. Very insightful. Thank you, Yvonne Kerry. I appreciate it. Send the details of Vedura to our emails. Thank you so much. We'll send that. Thank you, Kingsley. And awesome. Thank you, Mr. Daria Desoya. Somebody is asking, what is good rental yield? It depends on what you want, what your target is. Now, what we should ask is, what is the average rental yield for the normal rents that we have in Nigeria? Is between 2 to 5%. That is, so if you're getting anything above 5%, you're doing pretty well in the Nigerian market. We're still going to be sending this to all our emails. Thank you so much. Thank you so much. I hope this has been of value to you. Just about fun. I hope you've had fun too. How can I register as a realtor? Please, my colleague will post, Chris or Dami would post the link so that you can join our WhatsApp group as a realtor. Yes, we have a WhatsApp group. How much are we paying for commission? We're paying, depending on the kind of property you're selling, between 5 to 10, 15%, depending on what you're selling. Well, my colleague will post the link. You can register as one of our realtors. Thank you, Adobe. You said it was of immense value. Thank you so much, John Matthew. Oh, thank you so much. Thank you. Thank you. I appreciate it. Thank you very much. I would hand over the, thank you, Bridget. I appreciate it. Thank you. Please, is Dr. Para in the house? Thank you so much. Last comment. And then I want to find out, is Okwemi Lawal in the house? If you're in the house, I'd like you to just drop a note to say I am in the house. Thank you, Kadia Debule. I appreciate it. If Okwemi is in the house, please. Yes, we're gonna. Oh, that'll be Bossi's in the house. I'm in the house. Is that what I'm saying? Is that'll be a Bossi? I'm in the house. Okay, not this. Thank you so much, everyone. Thank you. Please, we're going to continue to share the different links. And then in another, we're based in Lagos. I'm responding to Rabia, we're based in Lagos. We're based in Lagos. Thank you. Thank you very much, everyone. Have a great night rest and have a wonderful holiday tomorrow. Thank you. and I would love to market your product. Just kindly complete the form as one of our consultants, and then we'll get back to you. Thank you so much. We'll be inviting you to subsequent webinar. I thank you for letting us know that this has been of value. Thank you so much. Thank you, everyone. Have a great time. Okay, we do just, I didn't want you to stop, but we just had to stop. Thank you so much. Happy Easter to you. Happy Easter to you. Happy Easter to you. Good night. Thank you so much. So, Madam Debbie.
Yes, sir. Good.
Maybe in another 5 minutes we can end, or in another 2 minutes we can end the webinar.
All right.
Because it looks like
For people that are still around, here is the link to indicate your interest for the Vedura. In case you're interested, please fill the form so that we'll get back to you. Thank you very much for attending. We appreciate you.
all right, have a
Yes,
great time. Yeah, bye. I think you should leave it because Kingsley is saying, how can I get added? Please send the link to him. Yeah, it's over. The webinar is over. We have some latecomers joining. And we have some of our attendants are asking me for calling them out. Like Dr. Farah is harassing me right now. Thank you. Thank you very much, Faith. We've sent the WhatsApp link. Please let's resend it so that Mr. Kingsley can join. Dr. Farah, thank you for complaining that I called you out. Apologies for that. Thank you. Thank you so much, Dr. Farah, for complaining.